Picture this, a younger, slightly less financially savvy me, trying to pick stocks. I thought I was the next Warren Buffett, chasing those hot tips like pigeons chasing breadcrumbs. Spoiler alert, it wasn't pretty. My portfolio looked like a sad, wilting plant.
That's when I stumbled upon mutual funds. Imagine a basket, but instead of picnic snacks, it's filled with stocks or bonds managed by financial wizards, hopefully not the kind that turn into pigeons. Mutual funds pool money from many investors to buy a diversified portfolio of assets. It's like having a team of experts picking investments for you, minus the hefty fees of a personal financial advisor. Less stress, more time for Netflix. Sign me up! Think of a mutual fund like a basket of goodies at a farmer's market. Imagine walking through the bustling aisles, the air filled with the scent of fresh produce and baked goods. Each stall offers something unique, from juicy apples to crisp lettuce, and even homemade jams. Just like this market, a mutual fund offers a variety of investments all in one place. You get a taste of everything without having to buy a whole bushel of apples you won't eat before they go bad. Instead of committing to a single type of investment, you get a little bit of everything. This way, you can enjoy the benefits of diversification, which means spreading your money across different types of investments to reduce risk. Each goodie in the basket is a different investment, like a stock or a bond. Stocks represent ownership in a company, while bonds are like loans you give to companies or governments. By having a mix of these in your basket, you can balance the potential for growth with the stability of fixed income. By owning a bunch of different things, you're not putting all your eggs in one basket, because nobody wants a financial omelette, right? Diversification helps protect your investments from the ups and downs of the market. If one investment doesn't perform well, others in your basket might do better, helping to balance things out.
This magical basket is managed by a fund manager, a financial whiz who decides which goodies to put in and take out. They are like the expert chef at a gourmet restaurant, carefully selecting the finest ingredients to create a delicious and balanced meal. They use their market knowledge and expertise to try and get you the best returns. Fund managers analyze market trends, economic data, and company performance to make informed decisions. Their goal is to maximize your returns while managing risk, much like a skilled gardener tending to a diverse garden to ensure it flourishes. It's like having a personal shopper for your investments, but without the awkward small talk. They handle the complex decisions and adjustments, so you can focus on other things in your life. With a mutual fund, you get professional management, diversification, and the potential for growth, all wrapped up in one convenient package.
Just like ice cream, mutual funds come in different flavors. Each type of mutual fund has its own unique characteristics, much like how each ice cream flavor has its own distinct taste and texture. Whether you prefer something rich and indulgent or something light and refreshing, there's a mutual fund out there that can match your investment style and goals. Okay, not really, but they do come in different types based on what they invest in. These types can be broadly categorized into equity funds, bond funds, and balanced funds. Each category serves a different purpose and caters to different investor needs.
Equity funds are all about stocks, which are like tiny pieces of ownership in companies. When you invest in an equity fund, you're essentially buying a small part of various companies. These funds can focus on different sectors, such as technology, healthcare, or energy, and can be diversified across different regions and market capitalizations. They're considered higher risk, but offer the potential for higher returns. The value of these funds can fluctuate significantly based on market conditions, company performance, and economic factors. However, for those willing to take on the risk, equity funds can provide substantial growth over the long term. Think of them as the double chocolate fudge brownie of the investment world. Delicious but intense. Just like how a rich, decadent brownie can be a treat for your taste buds, equity funds can be a treat for your portfolio, offering the potential for significant gains.
Bond funds, on the other hand, invest in bonds, which are like IOUs issued by governments or companies. When you invest in a bond fund, you're essentially lending money to these entities in exchange for regular interest payments. These funds can include government bonds, corporate bonds, municipal bonds, and more. They're generally considered lower risk, less sugar rush, more slow and steady, and aim for stable income. Bond funds are ideal for investors looking for a steady stream of income with lower volatility compared to equity funds. They can provide a cushion during market downturns and help preserve capital.
And then there are balanced funds, the Neapolitan of the mutual fund world. These funds combine both stocks and bonds, offering a balance of risk and return. By diversifying across different asset classes, balanced funds aim to provide growth potential while also mitigating risk. They combine both stocks and bonds, offering a balance of risk and return. Balanced funds can be a great option for investors who want exposure to the growth potential of stocks while also benefiting from the stability of bonds. They can help create a well-rounded portfolio that can weather different market conditions. It's a bit like having your cake and eating it too, but with, more charts and graphs. By investing in balanced funds, you can enjoy the best of both worlds, the potential for growth and the stability of income. Whether you're a conservative investor or someone looking for a balanced approach, there's a mutual fund flavor out there for you.
Now let's talk about why mutual funds are the cool kids on the investment block. First up, diversification. Remember the basket analogy? That's diversification in action. Imagine you have a basket full of different fruits. If one fruit goes bad, you still have plenty of others to enjoy. That's exactly how diversification works in mutual funds. By spreading your money across different investments, you're not putting all your eggs in one basket. This means that if one investment doesn't perform well, the others can help balance things out. You're reducing the risk of losing everything if one investment goes south. Think of it as a safety net for your money. Diversification helps to smooth out the ups and downs of the market, making your investment journey a bit less bumpy.
Then there's professional management. This is a biggie. When you invest in mutual funds, you're essentially hiring a team of experts to manage your money. These professionals have the knowledge, experience, and resources to make informed investment decisions on your behalf. You're essentially outsourcing the hard work of picking and managing investments to the pros. They do the heavy lifting, analyzing market trends, researching companies, and making strategic decisions to help grow your investment. It's like having a personal chef whip up gourmet meals while you put your feet up. You get to enjoy the benefits without having to spend hours in the kitchen. Similarly, with mutual funds, you can relax knowing that your investments are in capable hands.
And let's not forget about affordability. One of the great things about mutual funds is that they allow you to invest in a diversified portfolio even if you don't have a ton of cash lying around. You don't need to be a millionaire to get started. Mutual funds let you invest in a diversified portfolio even if you don't have a ton of cash lying around. You can start with a small amount of money and gradually build your investment over time. This makes it accessible for everyone, regardless of their financial situation. It's like getting a front row seat to the investment game without breaking the bank. You get to participate in the market and potentially earn returns, all while keeping your financial stress in check. So, whether you're a seasoned investor or just starting out, mutual funds offer a way to grow your wealth with less hassle and more peace of mind. Now, before you go all in on mutual funds, let's talk about the potential downsides. Market risk is the biggest one. The value of your investments can go down as well as up. Depending on how the market performs, it's like riding a roller coaster. Thrilling at times, but can also make your stomach churn.
Then there are fees. Yes, even those expert fund managers need to get paid. Make sure you understand the fees involved before you invest, as they can eat into your returns. It's like paying for delivery on your pizza. Sometimes it's worth it, sometimes not so much.
Choosing the right mutual fund can feel like navigating a maze blindfolded. But fear not, dear investor, it's not as complicated as it sounds. First, figure out your risk tolerance. How much risk are you comfortable taking with your money? Are you a roller coaster enthusiast, or do you prefer a leisurely stroll in the park?
Next, consider your investment goals. Are you saving for retirement, a down payment on a house, or that dream vacation? Different funds align with different goals. Don't be afraid to do your research. Read fund fact sheets, compare historical performance, and understand the fees involved. There are even websites and apps that can help you find the right fund for your needs.
So, there you have it, a crash course on mutual funds. Remember, investing doesn't have to be scary or complicated. Mutual funds offer a simple and accessible way to grow your money over the long term. Just like building a house, it takes time, patience, and a little bit of sweat equity, figuratively speaking, of course. Now go forth and invest wisely, my friends.
And remember, the best time to plant a tree was 20 years ago. The second best time is today. Like and subscribe.